I'm Owen Bigland. This is the Inside Edge video blog. Okay, I'm going to call this one Good Things Happen, and happen continuously and on a daily and even weekly basis when you are in the market and you stay in the market. In other words, you've got a game plan. You're an investor long term, which is what investors are all about, could care less about what a real estate market or a stock market does today or tomorrow or next week or next month. You're only concerned about buying that home or buying that stock and what it's going to do in 10, 20, 30, 40 years. That's the only advantage you have as an investor, unless you want to become a speculator. And speculation does not work in real estate, as I've often said, because the friction costs of buying and selling are crazy high with the taxes and the commissions and everything else. So this one, I'm going to give you some real life things that happen to me on a daily basis, both in real estate and in my stock portfolio. And these are things that I want to get your opinions later on in the comment section. A lot of you probably going to be an eye-opener for a lot of you here. You're not aware of a lot of these things. And the reason being, as I've often said, the media, mainstream media, for the most part, does not talk about this stuff. It's too positive. A lot of people I talk to on a daily basis when we're talking about stocks and investing, I tell them about some of these things and they've never heard of it before. So good things always are happening to me on a daily, weekly, monthly basis. So I'm going to give you some real life examples here. Let's talk first about my stock portfolio. So as you guys know, or if you've read my book, I've built a well-diversified portfolio over the last 25 years. My first stock I ever bought was Pepsi Cola. I still own it today. I've made I don't even know what my returns are on this, probably 1,500%. It's very difficult because I've had so many spin-offs, so many stock splits on it, and so many company splits, which I'll tell you about, that I'm not even sure what my initial returns are on my first purchase of Pepsi. I've bought it many, many times over the last 20 years. I think even the stuff Pepsi I was buying 10 years ago, I'm probably up 500% on. But when you own a diversified portfolio of the best, which is, I've always pounded home to people, buy the large cap dividend aristocrats or dividend growers. So these are companies that are so profitable that they will pay you a quarterly dividend. But even better, not only do they pay you a dividend every quarter, but every year they will raise that dividend. So if they're paying you $1 a year in dividends this year, next year they will probably raise that to $1.08 or $1.10, or an 8 to 10% increase. My typical dividend growth right now on my portfolio is running pretty close to 10%. I've got some that are paying me a little less, maybe a 5% increase, but I've got others, some of my real growers, that are paying me 15, 20% dividend increases. So let me give you some real life examples of some of the things that have just happened to me recently. Now, there's an old saying in investing, and you can apply this to real estate as well. To be an investor, you need to be a believer in a better tomorrow. And if you guys have read my book or watched my blog here over the years, you know I'm an optimistic guy. I am a believer in a better tomorrow. It's the only way to go through life. Doesn't mean you don't see the negative side and the dark clouds that are out there, but overall your mindset should always be positive. So in other words, if you're buying a Vancouver home today that you're going to buy, live in, and pulling the trigger on it, you want to be buying that with the belief that, do you think Vancouver will be a better city 10, 15, 20 years from now? If you don't, then you should probably just stay renting. I'm the same way with my stocks. When I pull the trigger on 100 shares of Macdonald's or Pepsi or Johnson & Johnson or Apple, I ask myself, do I think this company will continue to produce these obscene profit margins and cash flows, continue to pay me a quarterly dividend, and also continue to increase that dividend every year? If I have my doubts, then I don't buy the stock, plain and simple. Now, you're going to get a few setbacks. As Warren Buffett says, you buy the best of the best, you buy these big blue chip US corporations that even a ham sandwich could run. Because eventually, he would say, a ham sandwich will run the company for a while and the price might go down. But overall, these companies are so resilient, and they will get back on their feet again and off to the races they go. So I want to give you some prime examples here of just some recent things that have happened to me. Just in the last couple of months, I want to tell you guys some things. So last week, Costco. I've owned Costco probably now for about 10 years, maybe a little more. Incredible company. And now it has thrived in COVID here. There's been some winners and some losers in COVID, but of course some of these big box retailers like the Costcos and the Targets and the Walmarts have, absolutely exploded here during COVID. Costco last week just announced a special dividend, a $10 cash dividend for every share that I own. Costco is famous for this. This is at least the third special dividend I've participated in. The last one I think was about 2.5, 3 years ago. But in other words, if I own 100 shares of Costco, they are going to send me or deposit into my brokerage account $1,000 US cash. Every share I own is $10. Now this is incredible. This is an early Christmas gift. It's going to be paid, I think, on December the 12th. Nice to have. For every share, they're going to give me $10 special dividend. On top of that, Costco pays their regular quarterly dividend. That's going to continue, of course. And every year for the past 10 or 15 years, Costco has bumped up that dividend. They've got close to double-digit dividend growth. In other words, I keep it simple. If they pay you $1 this year in annual dividend, they will pay you $1.10 next year. Think about it. I talk about it in my book. This is inflation-proof. If you've got a portfolio that's generating $100,000, let's say, in dividends passively, and you've got an annualized growth rate on that dividend of 10%, this year they'll pay you $100,000, next year they'll pay you $110,000. If you can build up a big enough portfolio to live off your dividends, you will never run out of money, and you never have to worry about inflation ever eroding away at your purchase power. Inflation's running at 3%, and your dividend growth rate's at 10%. I talk about it a lot in my book. Other things that have happened here, just recently. McCormick, another one of my favorite companies, the spice maker. I talk about this, I've mentioned it in passing here a few times. Incredible business. The margins, spices, who knew? You buy the raw spice, package it up, the margins and profits are massive on this company. Again, it's what we call another dividend aristocrat. They've paid a dividend, and they've increased that dividend every year for, I think, over 20 or 25 years. Incredible company here. They just announced, they gave me a double whammy last week. They announced a 2-for-1 stock split. Now, stock splits generally, it's a psychological logical effect on the stock price. Generally, they don't do anything. You get 2 for 1. But I'll talk about it in another blog here. They do have a benefit. It's been proven that stock splits generally will boost the price over time. But they also announced a 2-for-1 split and a 10% dividend increase. Nike last week, another incredible company. I've owned Nike for probably 12 or 13 years now. Another company that the yield on Nike isn't huge, but it's a dividend grower. They continue to bump up that dividend every year by double digits. They just announced a 10% dividend increase. Stock splits. Stock splits galore. Apple just did a 4-for-1. Apple did a 7-for-1 stock split back 3 years ago. I'm getting those all the time. Company splits. So I'll give you a few examples here. I've owned Dow, the chemical company, Dow, for many, many years now. About a year ago, they split the company into 3. Dow, you got Dow DuPont, and then you got Corteva, which was a third company that they created. These can be incredible windfalls. Another prime example of this that just happened recently, earlier this year, was a merger between Raytheon and United Technologies. I've owned United Technologies for over a decade, incredible company. They merged the two together, and then they did a 3-company split. You now own United Technologies, Raytheon. For every 100 shares of United Technologies, they spun off their Otis Elevator division and their Carrier air conditioning division. I forget what the actual split was. I think for every 100 shares of United Technologies, I got 10 shares of Carrier. These can be incredible opportunities. Carrier opened up at, I can't remember it off the top of my head, it was maybe $15 a share. For every 100 shares, you got 10 shares of Carrier. Carrier is up close to 175% since that spinoff. Otis Elevator is up over 50% since that spinoff. Let's circle back to Pepsi. Pepsi, when I first bought it, the reason I bought it, it was a simple stock to understand. They make sugared water. The margins are incredible. At that time, they had their Frito-Lay division, Gatorade. They also had their restaurant division. They owned Taco Bell, KFC, and Pizza Hut. Well, about 12 years ago, 15 years ago, they spun off the restaurant division into Yum Brands. For every 10 shares of Pepsi, you got 3 shares of Yum Brands. Yum Brands now has had at least a couple of stock splits since then, and then they've also done another split for the Yum China division. So you see, this is why when you hold stocks like this as long as I have, I don't even know what my total returns are. They've been so magical on these. When you add the stock splits and the company splits and the special dividends and the increased dividends over the years, your returns start to compound, and they are just incredible what they can get for you. This is the kind of thing that happens to me when you own as many companies as I own. I probably own now about 60 individual companies, and then I've got probably about half of my portfolio in just ETFs, indexed ETFs, the TSX, the S&P 500, the Dow, the NASDAQ triple Qs. One of my favorite ETFs is Vanguard Dividend Appreciation Fund, or VIG. This one is in the sweet spot because this is companies that some people get confused on this. It's not companies that are high yield necessarily. These are companies that might only pay you a 1 or 1.5% dividend rate now. But this is filled with companies like the Costcos and the Visas and the Home Depots and the Nikes that are continually growing those dividends at double digit. So a 1% yield today could easily be a yield on cost of 10% in 15 years or so. So these are the kind of things that are happening to me pretty much on a daily and weekly basis when you own as many stocks as I own. I mean, every single year, the vast majority of my stocks that pay me a dividend announce a dividend increase. So I get 50 or 30 or 40 of those announcements every year. I get things like the special dividends, I get the stock splits, and then I get all these crazy mergers that spin off. Oh, another one, I just forgot here. 3 days ago, I've owned Pfizer, the pharmaceutical company, for many years. Pfizer, a year ago, bought Upjohn and Mylan, which was another large pharmaceutical company. Well, as of last Monday, they just spun that division off into a new stock. And for every 100 shares of Pfizer I owned, I got 12 shares of this new company. New company started trading on Monday, and it went up 12% in the first day. And that often is the case when they do these spin-offs. They're usually undervalued. And a lot of times investors will say, oh, with these new spin-offs, just sell them. My rule of thumb is I always keep them for at least 12 to 18 months because I find more times than not, these companies are undervalued when they spin them off and they're up 100% or 150% like a moonshot. So these are some of the things that happen to me in my stock portfolio on a daily, weekly, monthly basis. But you guys tell me, do you guys hear of these headlines ever? That Costco is going to give you $10 for every share you own next month on December 12th? Do you hear about these companies splitting off into 2 or 3 different companies? Do you hear about the stock splits? Do you hear about the dividend boost they're giving you of 10, 15%? You're not going to see this stuff in the Vancouver Sun or the Province or CNN or most of the mainstream media. As a matter of fact, even Wall Street Journal and Barron's, which I subscribe to, they sometimes will mention this in passing, but I get most of these dividend increase notices and special dividends through a site like Seeking Alpha, where I put in my watch list, and any big events that come on earnings or dividends, I get a notification on it. That's how I find out about most of this good news. Every morning I'll wake up, I'll get my alerts on there, and oh, look at this. Home Depot bumping their dividend for me by 11%. Bell Canada bumping their dividend. TELUS, Fortis. It's good news all the time. Now, it's not all good news. Every now and again, one of the companies I hold will miss earnings. They'll get a pullback, or a news release will come out, or it'll be a drug that doesn't make it past the trial phase and the stock will get hit by 10%. But I would say my good news outweighs my bad news 5 to 1. But in the media, of course, as I've often said, bad news outweighs good news about 10 to 1. So these are the kind of things that happen when you're an investor. You buy the best and hold them. Real estate in Vancouver is the same thing, just not as a continuous flow that you get in the stock market. But some of the things that happened to me as a long-term Vancouver real estate holder on my investment properties. I tell you, I don't raise the rent on my tenants, but when a tenant does leave, if he's been in there or she's been in there for a couple of years, I will then bump up my rent to market rent. In some cases, that can be a $300 or $400 increase, depending on how long the tenant's been in there. Interest rates, of course, here over the last couple of years have just been on a steady descent. Where now, I've got clients now, maybe you guys can tell me what you've been locking in at. I'm hearing 1.7, 1.8% now. So every couple of years when I renew one of my mortgages or some of my mortgages, the rates just get lower and lower. I've got a rate, one of my properties coming up for renewal March 2021. I'm currently paying on this mortgage rate now 3.2%. So I'm looking forward to locking in, 1.9, 2%. Substantial drop in interest rates. That's the good news. The other thing I've talked about a little bit here is tapping into some of the equity. I told you guys that a lot of people are concerned about cash flow on properties. Cash flow is great, but I'm more interested in wealth creation, capital gains. Now, this is why you want to play 9 innings of baseball. For people that first buy an investment property or a detached or their principal residence, you're not going to see this for another 10 years. But after 10 years or so, you've got some nice options here. Let's say after 10 years, you've got $300,000 or $400,000 of equity in the home. Well, you don't have to sell the home to tap that equity. You've got a couple of options. You've got a home equity line, which you can tap into. But home equity lines are great, but they're probably going to be at prime plus another 1%. Let's just call it 3% or 3.25%. There's an even better way to do it. You can leverage those back up and borrow it at a new 2 or 3 or 4 or 5 year fixed rate, which is far below the HELOC rate you're going to get. So these are things that, for some of you, for new people that are just buying and getting their portfolios going, I want to tell you what you can look forward to here. A lot of good things will happen when you just buy, hold, and stay in the market. But, you're never going to hear about a lot of these things in the media. And just buy and hold good quality assets, and again, good things will start to happen to you. In the stock market, they come fast and furious. There's that old saying, another old saying in the stock market, if you can't kill it, buy it. And this is so true. This is why when I pull the trigger on a company like Pepsi or McDonald's or Apple, I ask myself, I keep it really simple. I ask myself, let's say Pepsi, which I've owned for 25 years. Do I see a competitor coming in and taking major market share from Pepsi? Is Joe's Cola going to come in and kill this business? Or is someone going to come in and invent a better Gatorade or a better Lay's potato chip? The answer is no, they're not. These companies like Pepsi and Coke have got such wide competitive moats. Their profit margins are solid, and they're going to continue to grow. Nobody's going to penetrate this fortress that they've built. And if they did, somebody comes up with a cola that is better than Pepsi, I can tell you what'll happen. Pepsi is so big and Coke are so big that they will drop their margins down. They will undercut these small players and drive them out of business. Now, I know some people will say, well, that's not fair and that's dirty pool. Well, if you can't kill it, buy it. And that's just the way these big corporations operate. Don't get mad at them. These are public companies. You can own them. And that's the final thing I'll leave you with. So many people look at the stock market like it's an enigma. It's numbers going up and down. And it's not. When you're buying a company like Pepsi or McDonald's or Home Depot or Visa, you are buying the greatest companies in the world. You own a small percentage of these businesses, and you're going to participate in all their profits. When you buy McDonald's, you're going to participate in get a small percentage of every Big Mac sold. You're also going to own, McDonald's really is a real estate company disguised as a hamburger chain. You're going to own the billions and billions of dollars of real estate that McDonald's owns. That's what buying these good companies is. It's not just numbers on a screen. And both real estate and the stock market, I think Warren Buffett would say this, the unfortunate thing is that in the short term, real estate and the stock market is a voting machine. A voting machine, meaning that it's at the whims of the market. Optimistic, pessimistic, the economy and all that stuff causes in the short term real estate and stocks to be volatile. But in the long term, real estate and the stock market is a weighing machine, like a scale. The cream always rises to the top. Always. Remember that. When you're buying Pepsi or Macdonald's or Apple or Home Depot, do you think these companies are going to still be profitable in 10 or 15 or 20 years? I do. If I don't buy it. Just like with Vancouver real estate. Do I think Vancouver is going to be every bit as desirable 10 or 15 or 20 years from now as it is today? I do, and I think it's actually going to be much more desirable. And that's what being an investor is. You're a believer in a better tomorrow. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.